Hey everyone, it's Brad from AirbnB-HostAdvisor.com. The bank isn't always your best friend when it comes to buying real estate or acquiring a business. There's a whole world of creative financing options out there. And today, I'm breaking down 7 of them that can help you bypass conventional loans and mortgages. Whether you're a seasoned investor or just starting out, understanding these methods can give you a serious edge in today's market. So, if you're ready to take control of your financial future and unlock the secrets to building wealth through real estate and business, hit that like button and let's get started. First up, we're talking about seller financing, also known as owner financing. This strategy is all about finding motivated sellers who are open to becoming the bank themselves. Imagine this: you find a property, maybe it needs a little work, or the seller is eager to offload it quickly. Instead of going through the traditional bank loan process, you strike a deal directly with the seller. They finance the purchase for you, acting as the lender. This usually involves a shorter term, think 5 to 10 years, with a larger final balloon payment at the end. The beauty here is the negotiation power it gives you. You can often snag a lower down payment and interest rates that are typically lower than hard money loans. The seller gets their property off their hands quickly and receives a steady stream of income from your interest payments. You, as the buyer, get to sidestep bank scrutiny and build equity in an asset. But remember, due diligence is key. Always get a real estate attorney involved to draft a solid contract that protects both parties. Seller financing can be a game changer, especially in a market where flexibility and speed are crucial. So don't underestimate the power of thinking outside the box. Next up, let's talk about a strategy that might sound a little risky at first, but can be incredibly powerful when done correctly. Subject to transactions. Instead of getting a new loan, you're essentially stepping into the shoes of the existing homeowner and taking over their mortgage payments. This can be a fantastic option if you find a property where the existing loan has a great interest rate. The best part? You're minimizing your upfront costs because you're not dealing with closing costs associated with a new loan. However, there are risks involved, like the due on sale clause that many mortgages have. This clause gives the lender the right to demand full payment of the loan if the property changes hands. Not all lenders enforce this clause, especially if you're consistently making payments on time. It's crucial to have an experienced real estate attorney review the loan documents and guide you through the process. Subject to transactions are often best suited for distressed sellers who are struggling to make their mortgage payments. Understanding the ins and outs of subject to transactions can unlock incredible opportunities in the real estate market. Now let's dive into a strategy that's perfect for those who aren't quite ready to buy a property outright, but want to get their foot in the door. Lease options, also known as rent-to-own. This is a fantastic way to control a property without actually owning it yet. You enter into a lease agreement with the owner, just like a regular rental, but with a twist. You have the option to purchase the property at a predetermined price within a specific time frame. This means you lock in the purchase price up front, protecting yourself from potential price increases in the future. To secure this option, you'll typically pay an option fee up front, usually a small percentage of the purchase price. A portion of your monthly rent payments goes towards the eventual purchase of the property. Lease options are great for buyers who need more time to improve their credit score, save up for a down payment, or test drive the property before committing to a purchase. It's also a win for sellers because they receive a steady stream of income and often a higher rent price due to the purchase option. Lease options can be a fantastic way to get into the real estate game, even if you're not quite ready for traditional financing. Chapter 4. Contract for Deed, Bridging the Financing Gap. This method is particularly useful for properties that might not qualify for traditional financing, and is sometimes referred to as a land contract. In a contract for deed scenario, the seller retains legal title to the property while you, the buyer, make regular payments directly to them. You'll typically make a down payment, and your monthly payments will include principal, interest, property taxes, and insurance. However, the seller doesn't transfer the deed to you until you've made the final payment. This means you're building equity in the property with each payment, but you don't have full ownership until the very end. Contract for deed agreements often come with higher interest rates compared to conventional loans, so weigh the pros and cons carefully. This strategy is beneficial for buyers who might have difficulty securing a traditional mortgage. While contract for deed transactions come with their own set of considerations, they can be a viable option for both buyers and sellers in specific situations. Now let's talk about a financing method that's become increasingly popular in recent years: private money lending. This is where you bypass the banks altogether and secure funding from individual investors or groups of investors. These private lenders are often more flexible than traditional banks and are willing to consider factors beyond your credit score. Private money loans typically come with higher interest rates, usually between 8 to 12%, and shorter terms, often ranging from 6 to 24 months. However, the beauty of private lending lies in its flexibility. Private lenders are often more willing to work with borrowers who have unique circumstances or are pursuing non-traditional projects. This makes private money lending an excellent option for fix and flip investors who need short-term financing to acquire and renovate properties quickly. Building relationships with potential private lenders is key. Attend local real estate investment club meetings, network with other investors, and clearly articulate your investment strategy and how you plan to provide a return on their investment. Let's explore the power of partnerships in real estate investing. This strategy is all about leveraging the strengths of multiple individuals to achieve a common goal. In a real estate partnership, you'll typically have two types of partners: silent partners and active partners. Silent partners are typically the ones who bring the capital to the table. They're investing their money but prefer to take a hands-off approach to the day-to-day management of the property. Active partners, on the other hand, are the ones who roll up their sleeves and handle the operations. They're responsible for finding the property, securing financing, managing tenants, and overseeing any renovations or maintenance. The beauty of partnerships lies in the synergy they create. You're combining the financial resources of one partner with the experience and expertise of another. However, before you jump into a partnership, it's crucial to have a clear and comprehensive partnership agreement in place. Partnerships can be an incredible way to break into real estate investing, scale your portfolio faster, and learn from experienced investors. Finally, let's explore a strategy that's particularly well-suited for commercial real estate and multi-unit properties: master lease options, or MLOs. This advanced strategy allows you to control and profit from a property without actually owning it. You negotiate a master lease agreement with the property owner, giving you the right to lease the entire property for a specific period. You'll typically pay the owner a fixed monthly rent, just like a regular lease. However, with a master lease option, you also secure the option to purchase the property at a predetermined price within a certain time frame. This gives you control over the property without the burden of ownership, at least initially. You can then sublease individual units or spaces within the property to tenants, charging them rent that's higher than what you're paying the owner. This difference in rent, known as the spread, becomes your profit. Master lease options are a fantastic way to generate passive income, build equity through the purchase option, and gain experience managing larger properties. However, MLOs are complex transactions that require careful planning and due diligence. Working with experienced real estate professionals, including attorneys and property managers, is crucial to ensure a successful MLO transaction. So there you have it. 7 powerful creative financing methods that can help you break free from the constraints of traditional loans and unlock a world of opportunities in real estate and business. Remember, the key is to thoroughly research each strategy, understand the risks and rewards, and consult with experienced professionals to make informed decisions. If you found this video helpful, give it a thumbs up, subscribe to my channel for more valuable insights, and hit that notification bell so you don't miss out on future videos. Happy investing!